I wanted to start by asking you about a life-changing encounter that you had back around 1982 with Warren Buffett, when I think you were studying for your joint law degree and MBA degree at Stanford University.
That's right.
And I wondered if you could tell us what he said that was so valuable and how that encounter shaped the way you've invested over the last 40 or so years.
The thing that struck me the most was how values-laden the meeting was. You understand that that's the same Stanford Business School where down the hall, upstairs and to the right, was a Nobel laureate, Bill Sharpe, whose premise in managing and harnessing the power of investment is that it's all mathematical. And it all has to do with the regression of prior returns against the benchmark, against risk that's deemed to be the market's risk. And there's so many assumptions. And Warren just talked about the things that were important to him as he placed money. And at the time, that had become a more important question than it would have been 10 or 15 years ago, because in those earlier episodes, Warren might have talked quite a considerable amount about coming up with net current value and liquidating value, and then measuring the price against those measures. And the margin of safety, if we were together 15 years earlier, would have been deemed a discount between the price paid and the value of those collective assets within a business. But they would have been finite, and they would have been based on the measure to which you received more than what you paid. The next steps were to try to release those trapped dollars and the trapped money and have it come back to you. And then you could redeploy it again and have it come back, and redeploy it again and have it come back. And each of those, you calculated the intrinsic value in roughly the same way, add everything up and then divide by the number of shares. And if the discount was wide enough, you buy it, and then you just wait until some force comes along to close that discount. And what happened is that it turns out to be difficult to manage large pools of money. And so he sort of grew to the point where it's harder to deploy capital that way. And you don't develop any kind of skill of business judgment, which was the next chapter. We actually were in a class where the lecture happened about the time that he was moving to that next chapter. He had bought See's chocolate several years before our session, and they had paid $30 million plus or minus for the brand and for all that came with it. And what they discovered is, owning that powerful brand, they had something which they hadn't adhered to before, which is called economic goodwill. It arises from the fact that the purchaser of that chocolate doesn't believe there to be an adequate substitute. And without the sense of an adequate substitute, they will bear price increases begrudgingly, in some cases willingly and even enthusiastically, because in some measure, the price paid is part of the bargain, because the recipient of a gift of that chocolate knows that somebody stepped up and paid a little bit more. And so when they bought the business, Warren, I gather this to be true, took on the responsibility for pricing chocolate, because once he realized that the price paid is part of the benefit received, he wanted to make sure that the price was always confidently raised, and recognizing that if he kept his side of the bargain, that the consumer would take that on. Now, his side of the bargain included something else, which is very interesting. It was more strategic, which is that there are lots of chocolate companies like See's Chocolate back in those days. Fannie Mae, Fannie Farmer, all these different companies, Russell Stover, and they all fought for market share. And so they cut prices, which of course was exactly the opposite approach that Warren took, which was to raise the quality of the chocolate, raise the price, and have that feedback loop keep their clients lawfully. The other trick is he realized, and this became very important later in my life, he realized, so he said, that in order to make a good return for a year in an investment with See's, you had to be willing to suffer, had to be willing to not earn a good return for 8 months of the year, because you really only make money during the four sort of pillar holidays of Easter and Valentine's Day and Christmas and Thanksgiving. And the rest of the time, you're lucky to break even. But it's only because you suffer through that you end up being the chocolate of choice at the higher price when it's called upon to serve. Now, where that would evidence an important feature is that if just lucky enough to just buy that seed, the typical buyer would command a team of analysts who'd come in and they'd come back and say, "Eureka! I see what's going on here. You're not doing anything 8 months of the year. You should really put in ice cream during the summer and soup, hearty soup during the cold of winter, and really get the full leverage off of those assets, sweat those assets more." And of course, it's exactly the wrong step. And that was the beauty of Warren's insight, is that he didn't have to deliver profits every month, every quarter, every 4 months, whatever public companies often have to suffer from the expectations of placed upon them by Wall Street. He figured out that he's much better off by maintaining the structure, kind of shutting down for the months when there's no activity, but just maintaining a skeletal crew, being always there for someone who needed the product and charging a lot for that. And I took from that the strength of brands, the notion of being willing to show losses, even when you're building wealth.
And I think he wrote a few years ago in the annual report that that $30 or $35 million investment has made them over $2 billion, something like that, over the decades. So it's a beautiful example of the power of a brand, a really great brand that you can ride for decades, which has become a fundamental theme in your career.
Yep. And I'll say there's another piece to what you just brought up, which was, that he feels as a chief executive of the enterprise, Berkshire Hathaway, he treats it like a partnership. And he wants to make sure that his partners know the value of what they have. Now, he's not going to tell them the value of what they have, because I guess he must think that's part of the fun of the game, or it's his competitive advantage to know his own intrinsic value on a per share basis. But when he wrote that in the annual report, he did so around the time that he was beginning for the first time ever to meaningfully consider share repurchase. And a part of his expressed need for preparation for engaging in that activity is he had to come to terms with the inevitable sense of being at odds with your partner, because you're going to be buying from your partner those shares that exactly what they're worth as the CEO of the company, and the seller can only approximate what they're worth. And he felt deeply enough that he thought it was important at that early stage to describe the bounty that was delivered by Seas. He talked about the extraordinary bounty that was delivered by Geico, since they bought full control of that. And each time he said he just wanted to make sure that the components that one would want to look at. And then most recently, he went to those 5 pillars, the approach where he had his equities, his operating companies, and the other assets that collect form Berkshire's valuation. And so he's struggled with that in a way that makes me feel more comfortable as a partner of his in Berkshire Hathaway, which is that he's thinking about how to make sure that we don't make a bad trade to his advantage.
A couple of really foundational principles that I think came up in that first meeting with him back around 40 years ago. I remember you describing to me, and when we talked about this a few years ago, I think when I first interviewed you, probably about 7-8 years ago. One of them is related to what you just said, that he's kind of looking out for your best interests as a shareholder, treating you as a partner. And you quoted to me him saying at the time, you can't make a good deal with a bad person.
Yes.
And I wondered if you could talk about that, because you said that, I was reading one of your recent shareholder letters, and you said, it's my belief that Berkshire has the least amount of agency cost of any company I follow. And this is such an important idea, and it's a piece of jargon that it's easy for us not to understand. Can you talk about that sense of treating people decently, not taking advantage of your partners, and reducing agency cost, which turns out to be one of the greatest risks facing all investors?
Yes, I completely agree on the final point there. And it really is the tendency of someone to try to make another person's assets, to which they're hired to supervise and to maintain and to develop and grow. But rather than hold those truths to be fully self-evident as the proper objective, they let slip in along the way a few here for me, a few here for me. And I was thinking about it one day not that long ago. I was looking out a neighbor's house. The lot line was planted with raspberries, and this lady who was in her late 80s didn't get around very much anymore. And I stopped by and I see her. And she said, I miss a lot. She said, but what I really miss are those fresh raspberries. We used to get a lot of them. And I was looking out one afternoon with her lawn crew, who were charged with the task of maintaining a decent looking lawn. They came around the corner. It was out of anyone's view, and they just dropped everything and ran to that raspberry bush and just ate it clean. And therein lay her problem, which was they were still producing, but her agents decided to take them for themselves rather than to allow her to enjoy them as she once did. And it's not a corporate story, but I think conveys the principle, which is that in business you have structures where you have options plans that are based on certain criteria. And Mr. Buffett will say this, is that one of the most critical jobs that they have at Berkshire is calculating appropriate compensation systems. And I recall him saying years back that he had something north of 140 different executive comp packages with his senior most teams, each one separately struck, and each one commanding about 3 pages. Now, if you ever looked at a comp book for the public market counterpart of the book that Warren drafted in 3 pages, you realize it's several hundred pages long, and it doesn't necessarily incent what you really want to incent, but it's more protective than it is collaborative. And so we deal with that reality, and mostly the compensation that's used today has a substantial component that's equity linked. And so that equity link invites into the operations and the expectations and the deliberations of a company. It invites in the presence of Wall Street, because if it's going to be equity linked, they will have all sorts of reasons to explain to you why, if you do the following 7 things, you'll hit the target. They'll make their numbers. If they make their numbers, the shares will trade up, and you'll have an overweight for that particular thing. And you go from being underweight to overweight. And I just read quarterly results that came in last week, and it had to do with a brewer, and the brewer was committing to making some substantial investments, and in the process of doing it, it disrupted their reported profit schedule, and the Wall Street voice was unanimous. They missed their numbers. You probably want to look somewhere else to deploy those cash, because they missed their numbers, and of course we celebrate that, because if they miss their numbers because they're expanding and developing in a thoughtful way in the first place, we'd like to have them miss their numbers by an even broader margin, if it meant that if they're investing upfront with more vigor, and that's really the trade-off. And so I'd say we're on the other side. On Wall Street, there's a very standard parlance called cash flow conversion ratio, which is a common language and a common expectation that is often commanded, and basically it wants you to give back almost all the cash that you earn, give it back to the investors, and 100% cash flow conversion ratio, you're giving it all back. And our goal is to have it stay put in the company. We chose the company to invest in because they had the prospects with the capacity to reinvest, and not all companies do. And so the last thing we want to do with the businesses that we most esteem would be to take them out of that reinvestment model. And that's where the kind of the mischief takes place as it relates to agency costs, is that your compensation will be set largely by the stock market recognition of what Wall Street allows them to think is the level which they're optimizing their responsibilities at the company. And our view of that is that they're taking a very long view, and they're pouring substantial money into building out the infrastructures that will reward people 10 years from now. But they'll do so as a result of the successful deployment of the capital into expansion. And unfortunately, when you embark upon a plan like that, it's going to weigh adversely on near-term results, because you will be funneling your investment spending, and it will mean that you're operating at less than full capacity, and there's disruption in general of trying to keep workplaces in order and all the rest. So when you're investing for the future, you're burdening the present, and we're perfectly comfortable with that trade-off, because we're interested in more gain, pain today for more gain tomorrow.
So it's a totally different mindset with Warren and Charlie, right? They're paying themselves, I think, $100,000 a year each, and so probably in that stack of compensation documents, they're the ones who get paid the least, and so they're making money with you, not off you.
Yes.
And we
have the right to participate.
Yeah. And you participated to an extraordinary degree, right? I think you first invested around 1982, and you must, when what, the stock was around 900 or something, and
about 900,
445,000.
Yeah.
And you must have invested these days, what, somewhere between $1 billion and $1.5 billion, $2 billion in Berkshire Hathaway. So this is a huge bet for you.
No. So it would be our firm.
That's what I mean.
I oversee.
Yeah,
I think it's closer to probably about $1 billion, $4 billion, $3 billion, $4 billion, and we're delighted to have the ability to have those assets. And people often say that it's sometimes a criticism. Why would I want to hire you to buy what I could buy for myself, or that I could buy it myself with Warren? And what people don't realize is there is an extraordinarily high benefit that comes from the structure in which all of the activities take place at Berkshire. It's not just a matter of, it's not an old-fashioned conglomerate where you have some kind of vision that everything will work smoothly with one another and create this synergistic top. Rather, it's in some ways different. It's the send it back to Omaha story that I think is what is at the heart of what makes Berkshire unique and interesting, which is that when you have a family business, call it TTI, which is run by a guy named Paul Danforth, I think his name is. I'll have to take a look. But anyways, and Warren bought that business, I don't know, 15 years ago. And it grew at its operating margin 15% per year for the entire period that he had held it. It was up sort of threefold in 10 years. And, all along the way, he gated himself on the cycle of reinvestment, but he would make investments. It was an electrical contractor distributor business. And the killer application there is that they have everything under one roof from all the different manufacturers in the world of these different products. And so if you're trying to run a lean manufacturing company, you might be inclined to work with TTI, because with just one call, they can composite the order, send it to you by 8 o'clock the next day, and you're in business. And it requires deep inventory, a huge warehouse, and a commitment to customer service. That means you'll never let them down. And the people who run those companies begin to think that they can't do without the services of TTI. And we're always in the marketplace looking for businesses where the consumer can't live without the product that our businesses offer. Now, he was an interesting case because he was able to deploy the money internally, but many people are really great managers of the electrical wholesaling distributor business like this, are fabulous managing their team, projecting out when they next need capacity, and a host of other features. They're excellent at it. But many of them, once they end up with a pile of money at the end of the year, they really don't have a need for it. And in that case, it goes to Omaha and it fills the pot. And now there's $140 billion of that money waiting for someone within Berkshire's family to have a project that they themselves want to jumpstart. And I heard about this sort of anecdotally through Kevin Clayton at one point. And I said, what's life like for you after Berkshire acquired you? And he said, well, we stopped having to worry about capital. And it's a two-sided worry, that we have to worry about deploying it when we have no good ideas, or that we want to give it to someone else so they can deploy it. But ideally, they'll have something to grow organically. But if they don't, the forced requirement that they do something smart with money that they face often as a public company gets them in trouble. in Kevin Clayton's case, he says that for him at least, the thing that changed by joining Berkshire was that he would have an opportunity to call Warren up, the best strategic consultant in the world, and ask him what to do as he considered an investment. And he said that Warren would fly him up in Defensible at the time, and they'd sit down, and Warren would say, "What's on your mind?" And then Kevin would sort of give the first question, the second question. And he said that by the time he had heard halfway through the second question, he began to have a sense of the answer. And by the end of the third question, he knew exactly what should be done. And the power of it was that he also owned the idea, because by virtue of answering the questions that Warren asked, he ended up having what ought to have been done revealed. And now I think one of the really big values within Berkshire has been the success rate of their investments, and measured in some ways by the mistakes not made as a result of those three questions against many different scenarios. The mistakes not made and those that should be made are made with full gusto, no questions about how much money to spend. But funneling all of this activity under one approach is that if you have money, you don't have an idea where it should go, send it to Omaha. If you have a project, you have to fund it, go to Omaha and get the money. And it's all based on sort of one-offs and not some kind of conglomerate magic. But it's the reason why, one of the reasons why we're so enamored by that company is that consultative role that's been played so well.
And Tom, when you look at the next generation of Greg Abel and Ajit Jain and Todd Jones and Ted Weschler, I know it's an awkward question to answer publicly, and you're probably inclined to be polite, but how do you assess this question of whether they have the right stuff, whether Warren's irreplaceable, whether they can safeguard the culture? Because obviously a huge amount of your own assets are riding on it. I think when I looked back, you had about 18% of your portfolio still in Berkshire.
Yes, I think it's really more like 15, and I don't know, Berkshire may have come down a little bit. It was quite a bit higher for part of this year as the story about the buyback sort of rippled through. But in any case, it is still in mid-teens, let's say. And again, it just, there are so few who are set up in the way that Berkshire is set up, that it gives them an advantage. I think of all the different, big investments that they made, the public equity put options that they, in a sense, underwrote as a form of insurance, $5 billion of premium, $30 billion of assets that needed to stay at that level 10 or 15 years out, and nobody else could bid on it. So Ajit has, in a situation like that, this extraordinary advantage that there will be periods of time, as Warren has taught us by showing us a table at one of the annual meetings, which showed the premiums written and then the combined ratio and the amount of premium that they have. And Berkshire would not write for half a dozen years in a row, nothing. And then over that time, the cycle rolls through, and then all of a sudden it turns south, and you can't make any money in insurance underwriting. Then you can't make any money, but you're going to lose your fortune, and it's even worse still. And it's only until it's even worse still that suddenly Berkshire shows up again and starts to underwrite at a time when others wouldn't, because the capital in the industry had been impaired because of the losses. And Berkshire had all the capital in the world to deploy with extraordinary favorable terms. And so I think their discipline, their patience means that they're able to see better opportunities before they swing. As he said, proverbially swing for the big fat pitch. I think that's the case where the big fat pitch was percolating along. And in the case of the put options, no one else would bid on that in a sense. Because you had to pass the movements through the equity market, valuation shifts through mark-to-market accounting. And so after they received their premium and began down this long journey together, over the course of the first 5 years, I think they passed through income $10 billion worth of losses. And very few insurance companies would be willing to take on that kind of naked exposure. At the same time, the insured had the comfort all along, even as those losses mounted, that Berkshire was good for it because they have however billion dollars worth of cash, and they're Fort Knox, and they promote the fact that they are Fort Knox, and so they're the last place that you can go when you really, really need insurance. And I think that they will continue to have the ability not to act. And so I often say that Warren's blessings in some ways is that he's willing to do anything, and he's capable of doing nothing. And in that scenario, he did no underwriting for the 7 years plus or minus that he showed us with zero premiums written. And then when the terms were indescribably attractive, he started to write like mad for about 4 years, and then he shut it off. And so I think and Ajit was his partner, I understand, in all of those big risks. And I can't imagine someone whose instincts would be better served for that time than Ajit's. And so I assume that he'll find someone else to share the thoughts with, as Ajit and Warren, in theory, reportedly share their analysis together. And he'll go forth for as long as he's able and well. He's of a generation, of course, older than Todd, not midway between Ted, I guess, and Todd. Ted would be midway between the two. And so it just presumes good health in the case of Ajit's ability to continue. And Greg Abel, has I think as I've seen him operate only through the annual meetings, I've spent very little time with him if outside that open forum, but he has a very assuring manner and seems like someone who can take on an enormous amount of responsibility. I do know, I've heard Todd Combs speak in many occasions over the course of the last year, and I get a sense that he's been invaluable in both the portfolios that he and Ted manage are both terrific, and then the assistance that they both start to give in the form of those questions. And in one case for Todd, it meant that he even moved down to Geico land, wherever that is, and became responsible for managing Geico as it conducted a sort of revision of how they assess risk proactively and use technology. Interestingly enough, use technology to replace what had always kept them out of trouble just fine, using the sort of analog and pre-digital type tools that they found created alignments that they could use to anticipate where risks might lurk based on history, not necessarily the modeling. They're mixing it up a bit now, as they found that the industry moved on, and those who are tooled with technology as an aid seem to have jumped a march on them. And so I think that's all undergoing some change. And you'd have to say that Todd earns his stripe as he comes home with the outcome that will arise from there. And then Ted, I understand, has had a huge role in several of the biggest positions, not overly heralded. He's also been seconded off to closing transactions on behalf of Berkshire when Warren has, as he said in the annual report, this is his disclosure, that when there's times when he just can't do something, he's had Ted go out and do that, and it's been terrific.